Imagine we buy $100 worth of eggs today that we will use to make cookies later. What is that $100? Is it an expense? Is it a cost? Is it a cash outflow? We'll discuss situations like this in this video as we address accrual basis accounting and the matching principle. So if you want to know more about the matching principle, stick around. The matching principle says we must recognize the costs and the associated revenues in the same period. So if we recognize the sale of a car in January, we also need to recognize in January the expense for the labor that built the car, the rent on the factory where the car was built, and the cost we paid for the tires. However, the matching principle only applies to product costs, those associated with the production of the product. It does not apply to period costs, those not associated with production. So we should recognize advertising costs when they are incurred, because advertising is not required to produce the car. The matching principle tells us to hold off on reporting expenses related to a product until the product is sold. How do we do that? Well, we do it with inventory. Inventory allows us to hold off on reporting expenses related to a product until the product is sold. When products are sold, we recognize their expense and remove them from inventory. But the matching principle is not the only reason for differences in timing of expenses and cash flows. We also have payment terms that may allow customers to pay us sometime after the sale is made. Typical payment terms might have the customer paying us 60 days after the sale. Payment terms also allow us to pay our suppliers or employees at some future point in time. Since there's no universal standard for payment terms, we accrue some amounts to adjust for the timing differences. Since there is no standard, come on. Since there's no universal standard for payment terms, we accrue some amounts to adjust for the differences in timing. For example, if our employees work the last week of the month, but they don't get paid until the end of the first week of the next month, we need to accrue the last week's labor expense. We do that by creating a liability on the balance sheet to represent the money we owe our employees. Since every entry has to have both a debit and a credit, we then put the offsetting debit of the entry into the expense account for the labor costs that we've incurred. Timing differences of income and cash flows have a profound impact on our accounting activity. These differences give rise to accrual basis accounting, which is what most large businesses use today. Earnings, from an accounting perspective, are meant to approximate the cash-generating ability of a firm. Companies that have high earnings should eventually have high cash receipts. Accountants report earnings so investors can forecast cash flows more accurately. Accrual accounting lets us manage cash flows and earnings in different time periods. We led off this video buying $100 worth of eggs. If investors care about cash flows, they would care that $100 left the firm today. However, when the cash went out, we received some eggs that we will convert into cookies in the short term. Later, we'll sell the cookies, hopefully for a profit. The recording of these events is where financiers and accountants diverge. Accountants are focused on following a strict set of rules that governs how transactions are grouped and reported to stakeholders. Financiers care about when cash enters and leaves the firm so they can assess the return on their investments. Accrual accounting allows us to bridge the gap between these two very different objectives. Let's end on a different example. Let's say we have a dozen eggs. Accountants and financiers diverge in classifying these eggs. An accountant would say we have 12 eggs because an accountant would never count their chickens before they hatch. A financier, however, would say at the present time, we value these eggs as 12 future chickens. How we handle timing differences matters in accounting and finance. Accrual basis accounting is the tool that bridges these differences.